What's going on, Penny Boys and Gals? It's MetaMatt here, also known as What the Duck in the Discord, and welcome to Class 33 of Penny Boys University Lite. This is part 2 of our class on behavioral finance. Be sure to check out part 1 before taking this class. Now, let's delve into an interesting concept in behavioral finance: prospect theory and the role of framing in decision making. Prospect theory is a groundbreaking theory in behavioral economics developed by Daniel Kahneman and Amos Tversky. It represents a departure from traditional utility theory, which assumes that individuals make decisions based on rational assessments of expected utility. Prospect theory, on the other hand, recognizes that people often make decisions based on the potential gain or loss relative to a reference point, rather than in absolute terms. For example, if option 1 is trading a stock that is worth $50 per share and has potential of going to $70 per share, and option 2 is trading a stock that is worth $70 per share and has a potential of going to $90 per share, both options are an increase of $20. But some traders might be more inclined to take option 1 because $50 is the reference point instead of $70. So the $50 investment might seem like the safer bet, because the way it's framed makes it seem like you are risking less. This leads us into framing effects. Framing refers to how information is presented or framed to individuals, which can significantly influence their decisions, particularly in situations involving risk and uncertainty. For example, presenting information about an investment in terms of potential gains may lead to different decisions compared to presenting the same information in terms of potential losses, even though the underlying fact remains unchanged. This demonstrates how the framing of information can alter our perception of risk and influence our decision making. So when you're looking at a trade, alert, or analysis, think to yourself about the framing of the wording and if it can cause you to make an irrational decision. Herding behavior is the tendency for individuals to follow the actions or decisions of a larger group, often without conducting independent analysis or evaluation. This is why we stress education here at Penny Boys, so you can learn how to make your own trades instead of playing follow the leader. Let's talk about how this has an impact on market trends and bubbles. When a significant number of investors start to follow a particular trend or direction, it can create a self-fulfilling prophecy. The momentum generated by herding behavior can drive prices further in the direction of the trend, potentially leading to market bubbles. For instance, during a bullish market, if a large number of investors start buying a specific stock based on positive sentiment and rising prices, others may join in due to the fear of missing out, FOMO. This can result in a surge in demand, causing the stock's price to escalate beyond its intrinsic value. In the same way, during a bearish market, if there's widespread panic selling, many investors may start offloading their holdings out of fear of further losses. This can increase the decline, pushing prices down even further. Understanding herding behavior is crucial for traders and investors. It shows us the importance of conducting independent research and analysis rather than blindly following market sentiment. Over trading refers to the tendency of some traders to make excessive and frequent trades, often driven by emotions like anxiety, excitement, or even boredom. This is us allowing either a big win, big loss, bad day, or lack of trading action for the day to cause us to trade with emotions instead of rationale. Overtrading can result in higher commissions, spreads, and other transaction costs. Additionally, it may lead to increased exposure to market volatility and potentially more significant losses. But most importantly, it typically leads to emotional trading, which then leads to losses or portfolios tanking. Regret aversion is a desire to avoid the emotional pain associated with making a wrong decision. In trading, this can lead to a tendency to avoid taking risks, even when it might be prudent to do so. This is basically being afraid to be wrong. Another way this can affect you is by causing you to hold on to a losing trade you picked out because you don't want to take a loss and be wrong. Anchoring is a cognitive bias that involves relying too heavily on the first piece of information encountered when making decisions. This can be towards a trading strategy or even a bullish or bearish bias on a certain stock. This can lead to biased assessments of value, potentially causing individuals to overvalue or undervalue assets or investments. This can also cause traders to rely too heavily on a certain strategy. Imagine you're considering purchasing a stock and the initial price target you see is $100 per share. This becomes your anchor. Even if other information suggests the stock may be overvalued, you may still have a tendency to view it through the lens of that initial $100 price. They say if you have a bad first impression on someone, it might take up to 20 more good impressions to change their mind about you. First impressions matter. Don't let this affect your trading. One way to lessen the impact of anchoring is to consciously seek out and consider additional sources of income and be aware of the information you might be positively biased to. Conducting thorough research and analysis can help provide a more comprehensive view, reducing the influence of the initial anchor. Additionally, setting predetermined criteria for the decision making can help override this anchoring effect. For example, establishing specific metrics for valuation or return on investment can serve as objective benchmarks. Now let's apply our understanding of behavioral biases to the world of investing. This is crucial for making more informed and rational decisions. Behavioral biases can significantly influence the process of selecting individual stocks. For example, confirmation bias may lead investors to seek out information that confirms their pre-existing beliefs about a stock, potentially overlooking critical contrary evidence. Biases can also affect the diversification of investment portfolios. Overconfidence bias, for instance, might lead investors to underestimate the risks associated with certain assets or sectors, resulting in an improperly diversified portfolio. For example, someone who is highly bullish on AI, but hasn't done the research on a specific AI company that might be bankrupt or failing. Behavioral biases play a substantial role in how individuals perceive and assess risk. Loss aversion can lead investors to be overly overly cautious, potentially causing them to miss out on a valuable opportunity. On the other hand, over-optimism may lead to an underestimation of risks. Now let's bridge the gap between theory and practical application by exploring how an understanding of behavioral biases can help us make informed investment decisions. Integrating what we learn from behavioral finance allows us to create strategies that are more aligned with human behavior and less susceptible to common cognitive biases. For example, incorporating techniques to mitigate overtrading can lead to a more disciplined and sustainable approach. It's not just about learning how to chart, knowing what stocks to buy, or reading fundamentals when it comes to trading. There are several investment strategies and approaches that draw on principles from behavioral finance. One is value investing. This strategy involves identifying undervalued assets that may be overlooked by the broader market due to biases like overreaction or availability heuristic. Contrarian investors go against market sentiment, taking positions that are opposite to the consensus view. This approach leverages insights from herding behavior and overreaction bias. You see, by knowing how behavioral finance can affect us, we can also know how it can affect others and use that to our advantage when trading. Now let's bring behavioral finance to life with concrete examples and case studies that demonstrate how these concepts play out in real-world financial markets. Case study 1, market bubbles and herding behavior. One of the most notable examples is the dot-com bubble of the late 1990s. During this period, investors exhibited herding behavior, flocking to internet-related stocks driven by fear of missing out. This led to a speculative frenzy and eventual market crash when the bubble burst. This also happened with crypto and NFTs. So when something new and shiny comes out, such as the metaverse or AI, make sure to keep these things in mind when determining stocks to buy. Case study 2, prospect theory and risk aversion. Consider the aftermath of the 2008 financial crisis. Many investors influenced by loss aversion became excessively risk averse, leading to a surge in demand for traditionally safer assets like government bonds. Case study 3, overreaction and value investing. In the aftermath of a negative event, such as a company's earnings miss, investors may overreact by selling off shares left and right. Value investors who recognize this overreaction can seize the opportunity to acquire undervalued assets. Mr. Stock Like Profit specializes in these types of plays. These case studies and examples show us the practical relevance of behavioral finance in understanding market dynamics and making more informed investment decisions. This is the key to having a step up in the market. I hope this class helped. If you want to do more trading psychology research, be sure to check out our series in the free education channel of our Discord. I hope to see you there, but as always, until then, I hope that you all make some bread.